outlook for the equity markets over next 2 years is reasonably good. The markets are at fair value, so don't expect exponential return because markets are not cheap. Last 1 year's return or last 18 months return came more from PE re-rating rather than earnings growth. Now it is unlikely that PE will get re-rated from current level. So your equity returns will be in line probably with what corporate earnings growth will be. In the second half of FY 2015, corporate earnings growth decelerated. It decelerated as capacity utilization of India Inc. came down. It decelerated because drop in commodity prices got reflected through inventory losses. It decelerated because working capital got stretched, liquidity was tight, and interest burden was huge. It decelerated because sudden appreciation of rupee against yen, euro, GBP resulted into exports taking a hit. Over next 8 quarters, we think capacity utilization will inch up. The commodity prices will now get reflected in better margin or higher volume through lower raw material prices. The liquidity scenario will improve, and the repo rate cut taken by RBI will get reflected into lower interest rates for corporate India. 1% drop in interest rate results into about 7% earnings growth. We also believe rupee will find its level against euro, yen and GBP, resulting into better support for exports. More importantly, the government has started capex cycle. They are spending 100,000 crore in FY 2016 across road, railway and other infrastructure projects. Combination of all these things will support corporate earnings, and we could see little bit back-ended, but certainly about 30% corporate earnings growth over next 2 years, and that should be supportive of the equity market. We are also going to witness another phenomena whereby provident fund will start investing in equity markets. Today, between EPFO and other private provident fund trusts, there is a corpus of about 13 lakh odd crore. The government has permitted them to invest between 5 to 15% of their corpus in equity funds. We believe this inflow of domestic investors through provident fund, which is an incremental inflow, will continue to provide support to the market, and that's a very welcome sign. Agriculture today constitutes less than 17% of India's GDP. Monsoon impacts only the Kharif season crop and not the Rabi season crop. So effectively we are looking at about 7.5% to 8% of GDP getting impacted because of the monsoon. If we go by the IMD predictions, this year's monsoon will be similar at 88% of its average as last year. Now last year, despite not so good monsoon, economy and markets delivered return to its shareholders. So probably with El Nino, if we still hit 88% average, we will see similar growth compared to last year. There's another agency, SkyMet, which is still holding on to its forecast, saying that monsoon will be above average. Now let's pray to the God that they give us monsoon which we deserve. The mid-caps and small-cap stocks have done well, and they have also been corrected in the recent time. That's the nature of small and mid-cap stocks. They are more volatile compared to large cap. Today, if you see mid-cap broad indices valuation, they are almost similar to large cap indices valuation. The history suggests that whenever valuation gap between mid-cap and large cap is too narrow, it makes sense to overweigh large cap as mid-caps tend to underperform. We believe in a scenario where corporate earnings are going to recover, albeit back-ended in nature, probably for the time being it makes sense to be overweight large cap or a blend of large and mid-cap funds rather than pure mid-cap. The way to invest in mid-cap funds will be through systematic investment plan so that the volatility of mid-cap stocks becomes a friend of yours rather than act as a deterrent. The EPFO flows which I mentioned earlier, they are also likely to move first towards the large cap stocks, and that will also support large cap stocks valuation. So looking at the potential flows and the valuation, it makes sense to be overweight large cap funds or blend of large and mid cap funds. And yes, you should invest in mid cap funds, but only through systematic investment plan. The equity markets today are on a consolidation phase, and yes, it does provide opportunity to investors to participate in the India growth story. We believe corporate earnings will grow as the government starts spending. We believe Indian economy will continue to benefit through the steps taken by the government and the entrepreneurs of India. And like in the past, where despite volatilities, equity markets have delivered better return than fixed income, better return than gold, and better return than real estate, the same trend is likely to continue. If I see retail investors' balance sheet excluding Indian promoters, between 10 to 12 trillion dollar worth of their assets are in real estate. Between $2 to $2.5 trillion worth of assets is in fixed deposits, tax-free bonds, and non-convertible debentures and fixed income instruments. Maybe between $1 to $2 trillion of their asset is in gold. And the equity, along with equity mutual funds, is just under $300 billion. The past has suggested that equity is a fast train. Real estate, gold, and fixed deposits and fixed income instruments are slow train. This asset allocation has to change in favor of equities, and the provident fund investing in equity market is a step in that direction. My feeling is that with support from the distributor community and the word of mouth publicity, we will see more domestic investors moving into equity market. Today there are 78 lakh SIPs done by Indian investors. A substantial part of that has happened in the last year. And we just hope and pray that in this consolidation phase of the market, they continue to invest and they continue to run their SIPs.